Video. Oh, hi.
Hello. Welcome.
Welcome to our new, not yet quite exactly used to studio. I'm Jillian Sidoti, and this is
Nancee Tegeder. This is my first time actually sitting in our new studio.
I mean, I've sat in it before and I've done things.
It's my first.
This is Nancy's first.
So welcome.
I could say a dirty joke here, but I'll.
Let's move on.
Okay.
We have exciting news.
We have exciting news. So we are going to be talking about opportunity zones today and opportunity zone funds and the regulations that recently came out. They came out before.
Right before Christmas,
Yeah.
The IRS released 544 pages. So
Nancee has memorized them all.
All of them. That was how I spent my Christmas vacation.
It was the most spectacular Christmas vacation ever. She couldn't come back. She couldn't wait to come back to the office and share all of her vacation dreams that had come true. Okay, so before we get into that, though, I want to talk to you. I want to show off our brand new shirts. We got all kinds of brand new stuff. It's like Christmas every day here at Sidoti.
We do. I didn't wear mine, so you'll have to just use.
Well, she's the star of the show today. I'm the meager host that is going to be asking questions. So we got because we got also something new, a new logo, which you probably noticed before you entered. It's a hot air balloon. We're in Temecula, California, where we have a lot of hot air balloons and wineries and all kinds of fun stuff. And the hot air balloon really represents lifting you up. And there's one of the things we did recently was we went as a firm on a hot air balloon ride. And for lots of us, it was the very first time we'd ever been. Was it your first time?
Again, my first. Lots of firsts at this firm. I'm scared of heights, and I was a little bit worried about it, but it was the most calm, serene experience. I'm short, but the buckets go up high, and I just felt very safe and secure. It was a really cool experience. So if it is not on your bucket list, I would recommend adding it.
Yeah, no, it was same thing. I'm scared of heights. It was never anything I thought about doing. As a matter of fact, I said to my husband, do you want to go? And his answer was hell no. He didn't want to go at all. So he didn't end up going with us, but our office manager, Clement, it was her first time. She didn't want to go either, but she ended up going too. And it was really quite, you used some really great words there. Safe, secure, it was calm, it was peaceful, and yet we were lifting up. And so that's why we have our
sponsor that hot air balloon company.
I know. And so that's kind of why we have a hot air balloon as our logo, because
we're famous for that.
We want to make you feel safe, secure, serene while lifting your business higher. So anyhow, so another thing that came out of that meeting.
So that night we were at dinner, and there may or may not have been too much drinking going on.
Not by Nancee. She's a good kid.
I don't drink.
She's a good kid.
Gene, he actually, for the past 11 years, he has traveled to Kauai in September, and he's run the half marathon. He's called an 11er out there or something like that. And so he has offered or suggested that the entire firm should travel there this fall, and that we should all run the half marathon together.
Yes, and we want to encourage you all to come and run the half marathon with us. We're not going to pay for you to come, but we want to encourage you to come, or encourage to come and cheer us on and come party with us later. And so that's the Kauai Half Marathon. It's over Labor Day weekend, and we're going to run a little contest today. So Gene came in, and actually I messed up a little bit because he brought in this huge big box of supplements, and I have a bottle of them here called Sport Legs, US patent number 6,699,906. Outperform your age. Now I will remind you that a 71-year-old man brought these into us. So can we get a close-up there, Tim? No, I'm joking. You don't have to do that. We're not that advanced yet. Maybe we aren't. I just insulted Tim. So this comes with 150 dietary supplements, which gives you more value. It's vitamin D, it's calcium, it's magnesium, and lactate to make you perform better. Now, Jean swears by these things. Jean swears by these things. And poor Lauren's like, can you get on with the subject matter? But before we do, I want to announce our contest. We have a contest, and we're going to give away these a bottle of Sports Legs shipped direct to you if you help us name our running team for the Kauai Half Marathon. So all of us from Trowbridge, Sidoti are going to be, not all of us, but most of us are going to be running the Kauai Half Marathon. Those who are medically excused only, who will not be running the Kauai Half Marathon, are on a team called Team Bloody Mary. And you are welcome to join that team, or you're welcome to join our yet to be named running team. And we want your help naming that team. So where can they put that? Where can they enter that information?
In the comments, right?
In the comments?
Yeah.
So if you're on Facebook, if you're on Zoom, wherever you are, just enter your suggested team name in the comments, and then we'll make an announcement of who the lucky winner is, what team name we chose, and you will be the lucky recipient of Sports Legs by Menon. Do you remember that commercial?
I do. That just aged us, though. So.
Okay, all right. So let's get on with it. I know you're like, geez, I came here for opportunity zones, and you've already been going for way too long about nonsense.
Well, I'm going to make Jillian come back into this. So we talk about these opportunity zones, and that the final regulations were gifted to us right before Christmas, and now we are going to be unwrapping what those changes are. So Lauren had this wonderful idea of presenting us with the gift. Am I putting this in here?
Yeah.
Okay.
Lauren's shy today. She doesn't want to be on screen.
We have a present, and we are going to, Jillian's going to be helping us unwrap the changes. Here, we'll move that to the preliminary regulations and what the final regulations mean. Now, there's a lot that came through, like we said, almost 600 pages. So we're trying today to focus on those that are most applicable to our clients and what they do, specifically with syndications and funds. There's definitely a broader scope of things. We'll try to take some Q&A at the end. If we don't get to everything, definitely please still put your questions in, and then later I can try and go back and respond to those by email if we don't have time to get to all of them.
Right.
So you want the questions in the comments? Or the Q&A?
Where do you take, you want them in the Q&A?
In the Q&A.
In the Q&A. And then if you're on Facebook, you can just comment below. Or if you're on YouTube watching in the future, you can just comment there and somebody will get back to you, but we will not answer those YouTube comments live. Okay, so the temptation to rip this paper off like a little kid at Christmas is, oh, poor Laura, look at she's dying over there.
A lot of time
Yeah, she just made this nice and pretty for us. So I'm not going to rip off. I'm going to ever so gently, like a little old lady.
And while she's doing this, I want to say, so we've done 2 previous webinars on opportunity zones. So we're not going to delve into a lot of the stuff that we covered in those initial ones. We're just talking about changes. So if you want some more basic information about it, or if you're confused about anything we're talking about, definitely go back and look at those. Lauren will put those links in the comments for anyone who wants to check that out.
Okay. So, oh, look at all of the gifts we have.
And we have to pull them out in a specific order to make sure it matches up.
Oh,
with our,
do it.
That one we can start with.
Okay.
This was made by my lovely 9-year-old this morning.
That's so great. I love it.
She was wondering why I was having her make all these things, and I tried to explain to her about 1231 games, and she was very confused. So hopefully we can make it a little bit more clear for you guys.
Okay, I'm going to put this down and let you talk about 1231 games.
Okay. So the 1231 game, the way it's worked with opportunity zones under the preliminary regulations, would be that you wait until the end of the year, December 31st, end of whatever year you're in, and you would net together any gains or losses that you would have. As far as so with the 1231 gain, or under the 1231 tax law, and I'm not a tax attorney, so I'm just giving you a very brief overview, but basically it's either a gain or a loss that comes from property in a trade or business. And so trying to decide whether something's classified as 1231, start with your CPA to get that classification. But once you've determined that it falls under the 1231 rule, that changed now under the final regs. So instead of having to wait until the end of the year and take all of your 1231 gains and losses and net it, and then the calendars start on that day for your capital gains, and then you have 180 days to invest that. They've switched it, and instead you don't have to do a netting approach. Instead, now whenever you have that gain come in, even if it's at the very beginning of the calendar year, you can go ahead and have your clock start then, your 180-day clock for investing that capital gain, and you can go ahead and put it in and not have to wait until the end of the year and then start that clock.
Oh, really?
That's a huge,
so that's a huge advantage.
it's
Excellent.
huge. And you don't have to net your losses with it
Oh,
at the end of the year. You
okay.
can just take your loss as an ordinary loss. So it's a huge tax advantage that was a gift from the IRS that it has been good. And the way that really affects our clients, most of them who are coming in with these 1231 gains, either their investors are coming in with that, or they have their own from their own partnership. It's usually from an LLC that you're getting these gains. This is just a way for you to be able to invest those gains earlier and start just taking advantage of the tax law sooner.
Okay.
So,
Excellent. All right. I think this one's next.
No, oh, this one didn't fit in the box.
Oh, okay.
That's why it's not here. So we have
Oh,
a
look,
lovely
free
for sale
advertising for
sign.
Sarah.
Sarah is my lovely friend who lent us this sign. We tried to find a for sale sign and could not. So what this is referring to is vacant property. Nobody is living there.
Mm-hmm.
So Sarah also said if I get her 3 new clients. So with vacant property, under the old rules, property, okay, let me back up a little bit, just brief overview. So there's different rules that apply depending on the type of land that you purchase. So some land, if you purchase an already existing building, you have to double the value of the basis. If you buy raw land or property that's considered original use, then you don't have that doubling requirement. You just have to increase the value, but there's not the doubling threshold. There was a lot of confusion on what does original use mean. IRS tried to define that as property that has not been depreciate yet, essentially. And that still stands. However,
depreciated yet by whom?
By the IRS. So for tax purposes.
By anybody?
But well, yeah, by anybody. So a lot of times it's somebody who's building a new apartment complex, and they build up to where they get their certificate of occupancy, and right before that happens, then they could
start depreciating,
and then that would be considered original use. They might sell it right at that point in time.
Okay.
And then someone could buy it for original use.
All right.
But the other big one was vacant property.
Mm-hmm.
And so they said, if a property's been vacant for some amount of time, we want to be able to also consider that original use.
Okay.
The idea behind, obviously, the opportunity zones is to incentivize people to invest and grow the areas where these properties are located. So for the old rule, a property had to be vacant for 5 years to be considered original use. The IRS decided that's too long, and so they've changed that a little bit. There's some nuances. So what you want to do is, if you find a property that you want to invest in and it's vacant, you first look at the date that that property was designated an opportunity zone. And that's per state. Most of these happened in 2017. 2000, it depends on the state. So go look at your property, figure out when it was designated an opportunity zone.
Okay.
If on the date that it was designated an opportunity zone, it was vacant that day, and for the whole year before that designation, they will treat that as vacant for purposes of opportunity zone funds, and you can consider that original.
So that's a huge gift.
That's way less time.
Because doesn't that bring in a whole lot more properties too? Yeah. Under that classification?
Right.
Okay.
Instead of a 5-year stretch, you've just got the 1 year.
That's nice.
So the trick with it is, the idea is the opportunity zone law is going to perpetuate and go for a while. So they also recognize, well, maybe the day that it was designated opportunity zone, it wasn't in fact vacant on that date, but perhaps it became vacant later. So if it happens after the fact, then you have a 3-year time period.
Oh, interesting. Okay.
So it's still shorter than the original one, but at least it gives you a little bit more time that you can work with these vacant properties.
Mm-hmm.
Which I feel with clients that we've had, usually there's something that's been abandoned. I don't see these as much. I would say the majority of our clients are dealing with existing properties. And so we'll talk about that as well. But there are some vacant properties in these areas. So.
Okay, excellent, excellent. So what's next? What can we take out next?
Now we can do the key.
Oh, I've been wanting to take that. I've been eyeing this.
So. Oh.
Okay, so what's this key mean?
Did I skip way ahead? Nope. Okay, we're good. So this, I just want to make sure you guys are seeing the same screen that I'm seeing. So anyway, this is a big change, and it actually has kind of had a negative effect for some of our clients, unfortunately. So
I know this one.
You do?
This is the only one I know.
Oh.
Because you and I discussed it.
We did. We talked about this in depth.
Sorry.
And yeah, so under the old rule, the problem is a lot of these property under the rule, you have to have purchased your property after 2017. And so we have a lot of clients who already owned property before that time, or they're trying to figure out how to take advantage of the opportunity zone laws, but still fall within the time frame that's required. So what we've been advising under the preliminary regulations is you could sell your property to an opportunity zone fund, and then whoever sold the property could take some ownership interest in that opportunity zone fund up to 20%.
Okay.
That's a related party rule. If you went over that 20%, then no deal.
Yeah.
So that's changed a bit. And so now what the IRS is saying is that's not really allowed, because what they're essentially treating that as is the seller is essentially contributing the property to the opportunity zone fund, because they get their money and then they put it right back in. And it's no sale is occurring. So that's why we need the sold key signed.
See how it says sold?
You have to have a sale in order for it to qualify as an under the opportunity zone laws.
Okay. So what if they kept some, like, do they have to keep all their money out, or can they keep some of their money out and put some of their money in?
There's a couple of different arrangements that we're finding will work. Your first option is you just don't sell your property and you don't take advantage of the opportunity zone laws. The second one is you sell your property, you get some capital gains from that, but you don't invest them back into that same opportunity zone fund.
Okay.
You can go find a completely different unrelated fund and put your gains into that.
Okay.
So, which is unfortunate, because then it's forcing you to go out with somebody that you're not, aware, and you'd rather put it into your own projects.
Right.
That's what's caused a problem for a lot of our clients.
Let's back up for a second. What if you take it, you contribute the property, you take the money, can you put it in another property that you own? Like, could you?
You could.
That you don't originally own, in other words.
So as long, they want to see a sale occurring. So as long as you're not putting your own capital gains from the sale back into that same fund.
It doesn't, so you could start a second opportunity zone fund that owns
totally separate property.
Just separate property. Yep. Even if you owned that property previously, contributed that property, could you take this money over here?
I don't even want to say contributed. You have to say sold. You don't want a contribution of the property. I know it's just a technicality, but that's important for them, the IRS, to see that a sale occurred. So let me try to understand. So I have a property. Yeah. I sell the property to your fund. I take my money that I made from that, and I go start my own opportunity zone fund over here with those funds. Is that what you're asking? Well, no, let's just say, couldn't you cross paths with properties, right? So like, let's just say you have property A and property B, right? And you want to put them into an opportunity zone fund. Okay. So you put property A into an opportunity zone fund and take the proceeds from that and put it into B. And likewise, you put B into here and put it into A. Do you see what I'm saying? You're like crossing. As long as you can show the funds you made from the sale did not go back into that same fund. They wouldn't. They'd go into B. They'd cross. But it's still, trickery. Yeah, a lot of trickery going on here. I don't know. It's really. I'm not like a criminal mastermind. Well, it sounds like it. So I don't know. This has probably been like the biggest hurdle, I think, for all of our clients. One suggestion is just sell it, get out, and be done with that property, because a lot of the opportunity zone properties have really appreciated in value because of this law. The final option that not many people have done but is out there is leasing the property. So I own the property, you have a fund, I can lease it, and the related party rules don't apply then.
Oh, interesting.
So, however, as far as that 20% rule, however, if you are leasing to a related party, you got to make sure it's done at fair market value, that you're not doing anything under the table,
Okay.
that you don't prepay it in the first year, you don't really have an intent to sell at the end. There's a lot of different little nuances you got to follow,
Okay.
but it might be a way around. It's really going to be very specific to each client. I just was on the phone yesterday with one walking through all the different scenarios. So if you're in that situation, that's definitely time to reach out for some help from us or somebody to just make sure you are aware of all your options and are doing the best one for your situation. It's very fact specific on deciding what to do.
Wow.
Oh, this is my favorite gift. We get to pull out the chocolates.
Oh.
I love chocolates. Okay, so, and we need the jar here.
Oh, look at this.
All right.
Oh, so we're aggregating.
We're gonna aggregate.
Look at.
Well, wait, not yet.
Oh.
So prior to the final regs, aggregation was not allowed. And so what I mean by that is, let's say I have an opportunity zone fund and I invest in property A and I invest in property B, but I'm required to double the value of these properties. Well, a lot of our clients want to put way more money into property A and they don't really need to put as much into property B. So I said, can we combine those and count the average and aggregate it basically and double that value and count it as both of them being substantial or doubled in value? It was very clear, no, you can't do that. Now with the final regs, there's a little bit more wiggle room.
Okay.
So we get to aggregate a little bit. So
Yay!
instead of having individual chocolates, we're going to group them together.
Look at this.
So now there is some aggregation allowed.
Oh, but not all.
Let's just fill it up. We'll leave some in the bag, some in the jar.
There you go.
So now what the rules say is that if there's multiple buildings on one deed, you can actually aggregate that way. So maybe you have one apartment complex that needs a lot more work than the other one, but they're all in the same plot of land.
Okay.
You can average it out over those as long as the overall value is doubled. Or the other new option is if you have contiguous parcels of land. So maybe property A is here, property B is here, same deal. What you want to look for in that, the parcels have to be touching. And then the other thing is, it basically has to operate like the same business. You have to have the same management. It has to look very much the same. So it's not as much aggregation as we wanted, but it is a little bit more than they initially allowed us to have. So
I think I know what our next one is.
oh, there's one for each of us.
Oh, look at this. There you go. If I had a hammer. Hammer in the market.
I don't know that song. I'm going with you.
It's an old 60s song.
So the next
You're
one,
the same age as me.
I know, but
Why are we using these like mics?
like, here's the thing. I have many skills, but one of them is not remembering lyrics to songs.
Oh, okay.
You can ask my family. I have some spot in my brain that never developed where I cannot remember a single lyric. So even if I had heard that song, I still would not be able to have joined you.
Okay, so substantial improvement. We're going to improve the property.
We are. And so this is a big one. This is what most of our clients are doing. They're buying an existing property in a rundown area usually, and they're going to invest and make it better.
Right.
And so the rule is that you have to double the value of the building.
Double the value of the building.
Yes.
So can you, because like, let's just say, I'll use like Compton, for example.
It's a good example.
Compton is, an opportunity zone. Clearly there's interest in getting that improved.
Yes.
However, it is right there outside of a major, very expensive metropolitan area, Los Angeles, in case you don't know where Compton is. And so that land is probably very, very valuable. so if the land is worth 500 and the structure is worth 200, that doesn't mean you have to make, which equals 700,000. That doesn't mean you have to make it 1.4 million. You only have to double the value of the building, right? You can separate those two.
Separate those out. And again,
and is that based on the assessors?
So that's something they clarified.
Okay.
We were thinking maybe it was based on what you paid for it. And now they're saying it's the adjusted tax basis.
Okay,
whatever
great.
that might be.
Yeah.
I was with a CPA that we highly recommend a lot of times is Amanda Hahn that helps us with opportunity zones. And I was sitting in another podcast with her, and she pointed out, and this is why I always say, have a good CPA on board that really understands this stuff. You know, from an opportunity zone perspective, you would really want to have the building be worth very little, because that's what you're trying to double, and have the land worth a lot. But from a depreciation aspect, that's vice versa, because you don't depreciate land, you can depreciate the building. So you would want to find where your numbers match up. But you still need to base it on what that adjusted tax basis might be.
Excellent. Okay.
So whoa.
Oh, sorry.
So that was the other thing. Trying to get that doubled sometimes is difficult. So a lot of what we do are multifamily. We've done hotels. So they've given a little more flexibility for what you can include in the doubling of the value. So an example would be for apartments, you're going to maybe have a room in your apartment complex that has gym equipment. You can count that investment towards doubling the value.
Okay.
Or maybe if you're going to go and replace all the refrigerators or something, you can start including some personal property as long as that is helping to facilitate the use of that property.
Okay, so let's back up for a second. So if I buy a property for $700,000 in Compton, the building is worth 200. I have to put in $200,000 in cash. That's how they're determining what the added value is. It's not a perceived added value. It's actual dollar for dollar value. So I'm probably, if I'm putting in $200,000, I'm actually probably more than doubling the value of the building.
Very possibly, yeah.
Okay.
They just want to see, you have to have a plan of action, and there's reporting requirements every 6 months to show what you've put in.
Okay.
So that's pretty strict. And again, that's where you want to have someone, a CPA who's helping track all that and reporting that to make sure you're staying compliant. But yeah, so with that example, maybe you pay $100,000 for structural renovations, but then you want to put in another $100,000 to upgrade everything. All the personal property. So that can count towards that, which is nice. It gives a little more flexibility for doubling that as well. And that also goes for, so that's for properties. Opportunity zone properties, but there's also opportunity zone businesses.
Sure.
And there's different thresholds you have to meet that count towards improving. So they help you when you're renovating. A lot of times you're not necessarily doubling the value of that structure at that time. There's lots of other expenses you're paying for that renovation. And so there's just some more flexibility in what you can count towards that substantial improvement threshold.
Okay.
So that's been good. One point I do want to make, going back to when we talked about you actually have to have a sale occur with the property. You can't just contribute it to your own fund. If you were to contribute, that would not be considered a qualified property. And so they did clarify, if you're substantially improving a property that isn't technically qualified, that doesn't count towards these rules.
Oh, no
so you got to
kidding.
really make sure your property is qualified under these opportunity zone laws.
Interesting. Okay. What do we have next? We still have lots of gifts.
Got 3 more gifts.
Which should I go
And
with?
again, I do want to clarify. You should go with the 10. There's instructions.
I see them. Okay, wait. My left back.
There you go.
Right. Oh, look at it. Oh, thanks, Lauren.
Also made by my 9-year-old. She did a great job. All right.
10.
So with opportunity zones, there's been a lot of hesitation on the correct structure. Some people are setting up a single fund, and that fund will purchase the property.
Right.
And then next fund purchase the next property.
Right. Like my first example when we were talking about how I could get around the IRS rules.
And that's been recorded. So the other structure that people use is a 2-tiered structure. And so you have the fund at the top, and it invests in a business, and then that business goes out and invests in the properties. So some people were a little concerned about the exit plan.
Mm-hmm.
It was pretty clear for just the fund purchasing the single tiered structure, the fund purchasing the property, you sell the property, you get your benefits at the end of 10 years. But because of the two-tiered structure, it was set up within a business as personal property. And so there was concern that, hey, maybe I wouldn't have an exit plan. I'm not sure I'm going to get out of that. Will I still get that 10-year benefit?
Mm-hmm.
And they did come out and clarify, yes, that will also work. So the two-tiered structure, we're good to go. We've had a lot of clients who've taken that risk and just gone forward with it anyway. So good for them that it will work out, and they'll have that set up for them where you can exit either under single or double and still get that 10-year benefit. So, and we've talked about this before, but so at the end of the 10 years, what happens? Let's say you put in, you know, 100,000 in capital gains to your fund, and then in 10 years or 10 years plus, however long, you sell your property, you're ready to get out of the fund. Any appreciation that has happened, you don't pay federal tax on that.
Oh, wow.
That's one of the huge benefits of the Opportunity Zone Fund. So there was some questions on, well, what is actually excluded from federal taxes? And so, I forgot to switch my thing over. Did that go? Anyway, so you can pretty much exclude almost everything. If they say except ordinary income.
Right.
So people were wondering, I'm trying to remember what they said unrealized receivables could be included, depreciation recapture, all of that could be tax-free.
Wow.
Federally tax-free. So it's a good deal. That's why people are still interested in this. At the end of last year, we've missed one of those 7-year benefits of investing, but really the true larger benefits going to come after the 10-year mark. So it's still a good way to get in if you are interested in doing this. It's definitely a lot of tax benefits for setting this up. All right.
So, I bet I know which one comes next. They're
both, if you can.
Little boats.
Little boats. So we're going to talk about the safe harbor for
Are these your
capital.
sons?
These are my sons. I have a 5-year.
They
are
wow, look at that. How
If you want to borrow
fun.
them for your son, you can.
Probably. Oops, okay. That's enough of that. All right.
So safe harbor. So under the preliminary regulations, if you're a new business, you are allowed a safe harbor time frame for using cash, because they don't want you to just have cash sitting around. They want you investing. That's the whole purpose behind this law, is to get money back into these communities. But they understand with a new business, there's a lot of startup costs. You're going to have some cash on hand. You need working capital. So originally they said, new businesses, you have 31 months before you really have to have that invested in running your business. And now they've doubled that. So that's up to 30.
That's really great. Wow.
So that's awesome. Yeah, like they said, they were mostly gifts. Mostly.
That one thing was not a gift, but I think I found a workaround. Anyhow, it just involves buying more property, which isn't necessarily a bad thing.
There are a lot of workarounds. You just need to make sure you do it the right way so it stays qualified.
So do you want to take some questions?
We have one last thing.
Oh.
Well, our well-placed plant.
Oh.
Whoops. Here we go. I don't know where it went. All right.
Oh, I guess we don't. Oh.
I don't know if I actually have a slide for this one. It's not long. So at the end of the day, I said that. I thought,
excuse me. I thought that was the well-placed plant. Look at this.
So if you've been following us ever on our webinars, we typically have a well-placed plant. It really has nothing to do with our last point, but we thought we'd throw it in. So basically, I will say there's not every single question is answered. We're still going to have times when events come up or questions come up and the laws don't necessarily tell us how to proceed. So the final regs do have an anti-abuse provision.
Okay.
And that's just an overreaching look at what you're doing. Are you staying within the meaning of the intention, the intention of this law? Are you helping out these communities? Are you growing and developing them?
Okay.
If you're just trying to make this as a tax shelter and get around helping communities, that's going to raise some red flags. So if you ever have questions about whether you're doing the right thing, just always go back to that anti-abuse law and make sure that you're, what you're doing is really under the purpose of this law.
Okay. Well, I feel overwhelmed.
Yeah.
I'm
And
sure.
I've narrowed this down quite a bit.
I'm sure. Well, it's 500. How much? 594 pages.
544. Yeah.
So I'm sure the audience, feels a little overwhelmed. We have about 18 minutes to take questions, right?
Yeah. About 18. We'll see. So
I can read.
I can read far, not close actually. So that's good. So this question from Matt Ackerman says, in the 500 land and 200 building example, does the 500 for land have to be capital gains since it doesn't have to be doubled? So no, it does not have to be capital gains. You can put in, what you got to keep in mind, I mean, you can put all regular money into an opportunity zone fund. There's no requirement that it has to be capital gains, but you would get no benefit. The benefit only comes to those who put capital gains in. So if you put that 500 in, you're going to pay taxes like any other cash investment. You don't get that 10-year benefit of appreciation. You don't get anything. So you can put in whatever money you want, but really capital gains is where you're going to have that benefit.
Okay, I'm going to take this one. I hope I'm pronouncing this right, from Vamshi. Do you currently offer any opportunity zone investments for your clients to invest in? Well, I want to be very clear. We're not registered investment advisors, and we're not broker dealers, so no. The short answer is no. The long answer is if you would like to be introduced to one of our clients who is offering opportunity zone investments, we'd be happy to invest. We'd be happy to introduce you. We don't want anything. We don't need anything. Our clients don't give us anything, and we don't want anything from you. We're just happy to make the introduction, and hopefully that will work out for you. So while we're waiting for our next question to come up here, Nancee, what are some of the good, what are some of the opportunity zone funds that you've worked on? Like, where are you seeing these crop up?
So the larger funds that we work with are investing in multiple places. I would say one of the hot areas is Florida. There's quite a bit out there.
Oh, really?
Yeah, there's a lot of opportunity zones out there.
And what specific area of Florida? Because Florida is a pretty big state.
Really all over, a lot by Orlando.
Okay.
Up that way. It's really more they're just retirement communities and they're older properties and they're building them up. I've seen Texas has a lot.
So let's back. That's very interesting to me about Orlando.
Yeah.
Because Orlando is such a tourist town. And maybe you don't know the geography very well, but could you conceivably go into some of these opportunity zone areas, revitalize, and use them as Airbnbs?
If Airbnbs are allowed in those towns,
right?
Like our town just passed a law that
right
no longer had the Airbnbs.
Right.
Yeah.
Right. Yeah.
Yeah.
So we live in an area
more residential.
That's very residential. We do. Temecula does thrive on tourism a lot because we have wineries, we have the hot air balloons as discussed earlier. Yeah. So a lot of people from San Diego, Los Angeles come here to go and frequent the wineries, and they don't want to drive home. We don't have a ton of hotels here. And the hotels that are in wine country are rather expensive. So a lot of people were Airbnb-ing their homes in Temecula, and what ended up happening is the town passed an ordinance that makes it illegal to operate a short-term rental, as they put it. And they fine you $1,000 a day if they catch you doing that. So I happen to live, we both happen to live, and Lauren lives, and Tim lives, all in the unincorporated part of the town.
We should start Airbnb-ing our house.
So no, the minute that passed, I ran home to my husband and I said, where we're doing the casita, I'm going to make so much money.
And did you?
I'm planning on it.
All right.
Yeah, I'm planning on it. Listen, I gotta find opportunity everywhere.
It's been a unique development as far as what our clients are investing in. There's maybe a hotel up in Northern California or areas like Compton down in LA, retirement communities in Florida. We're doing an assisted living one out in Texas. It's really just a total random smattering of of investments. And I think most everyone now has heard the rule, you don't do the investment because it's an opportunity zone.
Yeah.
That's just a bonus. So
Right.
to say that I'm seeing, a majority of opportunity zones are X or whatever, I can't really group them that way, because you can't say the majority of what we do is any certain type of deal. I think it's kind of reflective of whatever the market is. You've got an assortment of different types of investments.
Absolutely. So, and it's so funny too, because actually one of my clients is doing, our client, because you do the opportunity zones, is doing opportunity zones and is hoping to do what he calls a barbell strategy of luxury and affordable housing, which I found and this guy's super smart, so I totally trust what he's doing. But like kind of having that yin and yang of properties.
And he might be doing that aggregation if they're all on the same land.
Right. But for a place like Inglewood, Compton, totally makes sense. Here's why. They're building the brand new Rams Chargers stadium right in that area. It's all going to be really nice development around that area. And so having a barbell strategy in that area makes perfect sense. So it is. Opportunity zones are.
It's a great chance for creativity.
It really is.
It's been fun working on these stuff.
So, all right, I'll ask this question. Can an opportunity fund invest in an LP whose sponsor is utilizing a traditional Reg D offering? Land is vacant and located in an op zone with development plan in place.
All right. So your fund wants to purchase a property in an opportunity zone, essentially.
Correct.
Going through a partnership. Depending on how you structure that, we could do the two-tiered system and should be able to make something like that work. Again, there's, we want to make sure it's been vacant long enough. We got to look at, make sure that purchase occurs. When did the partnership purchase it? So there's a lot of stuff to work through, but generally based on just what I'm reading, that should be able to work.
Yeah, and you always have to, if you're ever getting investors in, you always have to be mindful of securities laws. So the Reg D aspect of it is just, one way of bringing in the investors. So we're talking about two different things working together: tax laws and securities laws.
Right. The opportunity zone funds can work hand in hand with Reg D.
Right.
So most of what we set up, either through Reg A or Reg D, you just do it as an opportunity zone fund, but you still follow all those security laws.
So can if I sell land into a fund that I manage, but do not have ownership, is that a problem?
It shouldn't be under the law. They just don't want you to have any ownership. As a manager, you're just getting paid a salary. That should be fine.
Okay. And then the next one was about using stock sales. So can capital gains from stock sales be used to buy a property that you owned before 2017?
So if you take your capital gains from stocks can be used in opportunity zone funds. But then this part I have a problem with is investing in a property you own before 2017.
Okay.
So a sale has to occur after 2017. And then if it's one that you already own, we get into the related party conflict. So we would want to talk about, maybe you would want to invest your capital gains from the stock sales in something else. Again, this is why I say it's very fact specific. We'd want to look at, would you want to sell that property to somebody else, or how would we want to structure that? So, but you couldn't take your capital gains and buy your own property. Oh, I see what they're saying, because it's from
before 2017.
No, because the gains coming from the stocks, not from the sale of the property. I think that's what they're trying to say.
Yeah.
So you would still have to sell that property into a fund. So we would have to figure out what to do with your gains from that sale. But then I guess if you take your stocks, the gain from your stocks, and put it into that same fund, that might work. Okay, I see what they're saying.
Okay, Tim, I need that next question, please. Thank you. Can I have a partner to invest in an apartment development project who may or may not have capital gains? How the tax works?
So,
and that's how, listen, by the way, that's how the question's written. How does the tax work out?
Yes, so you are not required, again, to invest in opportunity zone funds with capital gains. Usually our sponsors don't come in with capital gains. Some do, some don't. they still get the benefit of whatever percentage of ownership they have, like any type of syndication. However, they would not have those capital gain benefits. So the sponsor would still, they wouldn't have that 10-year benefit that those who came in with capital gains are taking advantage of. But you still could definitely have partners in your sponsorship that don't have capital gains.
Okay. Hi, this is Sheila. Hi, Sheila.
Hey, Sheila.
I recently sold my property and my partner and I both had a gain. Could I put my portion of gain into the opportunity zone? Thanks.
Likely, yes. So if it's set up in an LLC and you each took, and it flows through to you individually, then absolutely yes, you could take your gain. And the nice thing with that, that I'll just throw out here real quick, that's different than the 1031 exchange, is under a 1031 exchange, you have to take your base and your gain and put it into a new property. With the example Sheila gave, she can take her base and just have it.
Okay.
She's already paid taxes on that and do whatever she wants with it. And then just take the gain portion and invest that in the opportunity zone.
Oh,
So
very cool. Okay, great. So I missed the connection between Airbnb and opportunity zone investment as I was taping my previous question. Well, you should have been paying better attention. Now, honestly, I kind of went off the trail there for a second. All I was saying was, I was basically trying to get at, are you limited on the use of the property app? Can you repurpose the property? Are you limited on that use? And Nancy's point was, well, you got to make sure what the zoning is. So now we're talking about a whole different area of law. But the answer is yes. From an opportunity zone perspective, you can do whatever the heck you want. Yeah, you can do whatever you want from that perspective. We were saying then from a municipal perspective, can you make an Airbnb? Because we've recently been involved, or we locally, recently, locally speaking, we know of cities and towns that are not allowing Airbnbs anymore.
You brought up a good point though. The Airbnbs would be allowed, but there are certain sin businesses that are excluded from the opportunity zone.
No kidding. I didn't know this. Go ahead.
So there things like golf courses or
golf courses,
so there, because the types of areas where you find opportunity zones, maybe the golf course isn't going to be the best use of that property.
I see.
So there's a number, it's a small list, but liquor stores, so they're trying to keep the types of properties you're developing to be in line with the communities that you're investing in.
Well, I'm assuming, because it is an opportunity zone and the whole point of this initiative is to improve communities that otherwise have not been approved by the current boom in the economy. So putting in a liquor store is probably not helpful. Pot shop, smoke shops.
That's the other thing. They haven't excluded marijuana specifically.
No way.
So
I guess because it's a federal law and they're like, well, it's federally illegal.
We don't know. There's two theories. Either it's illegal federally, so we don't even need to put it in because it's already illegal, or maybe it is allowed, but we just didn't put it in.
Wow.
We didn't exclude it specifically. So
that is crazy. How do I know if the fund is a safe one? Is there a list of A++ rated funds?
No. Not that I know of.
No, I mean, look, this is a whole other subject for a whole other webinar, which is, you need to know, like, and trust the people running that fund. And so the best way I can explain to you on how to check out a fund is to check out the principals in the fund, check out their track record, and really ask the tough questions. Make sure they know what they're doing and that their business plan is in line with what your with what they're saying they're going to do, and that they know what they're talking about. Oh, and another thing is, here's a great piece of advice for any of you who are thinking about investing in an opportunity zone fund, not necessarily doing it yourself. Never invest more than 10% of your net worth into any entity. That's how people get themselves in trouble, is that they get, dollar signs in their eyes, and their eyes get wide, and and their eyes become bigger than their stomachs, if you will, or their pocketbooks or their wallets, and they invest too much with one entity, and then they lose all their money. Just this morning I lost money in a crowdfunding campaign. The crowdfunding campaign, the company went under. It happens. But guess what? I didn't cry because I only invested a small amount of capital,
That's
a
okay.
very small amount of capital.
There's
So
always a risk. You
there's
gotta go
always
in
a
knowing the
risk.
risks.
So yeah, there's no list of A++ rated. type
I think we
things.
actually have another webinar of the questions to ask
Mhm.
before you invest.
Yeah.
So go look on our YouTube page, and it's not specific to opportunity zones, but you would want to ask the same question. So you definitely could apply it.
I do not know the answer to this, but I know the answer to most of these, so that's why you're here. I have 100 vacant houses in opportunity zones. If I treat the houses as a pool, is that allowed? Is that an aggregation and allowed or not?
So the rules say they have to be on contiguous parcels of land. So are these all spread out? Are they all next to each other? And you would also want to make sure they're run. Again, email me separately if you want, but there's certain specific rules that have to show they're run as the same business. When you talk about pooling, there's 3 points that you would have to meet. So possibly.
That's the
depends.
best non-answer
It
I've heard all
depends.
day. In order to qualify, does the ownership entity have to be 100% an opportunity fund? Oh, I think I know the answer to this, but I want to see if I'm right. In other words, if the owner is an LP, non-opportunity fund entity, who is seeking investors, can an existing, oh, wait, I went off the trail, I don't know. Can an existing opportunity fund invest and still qualify for the tax benefits based on upon its minority ownership interest?
That's an in-depth one.
Yeah.
So there's certain rules you have to meet as a fund. You have to say 90% of your assets are in a property in an opportunity zone. That may work. It would probably be safer to set that fund up under the 2-tier structure. And so you have maybe as a business investing in. There's just a lot of thresholds you would have to meet to make sure you qualify. So I would want to know more details about who you would be investing with in your relationship, and it makes me a little bit nervous.
See, I thought they were going in a different direction with that question.
They were going?
Well, remember we talked about that thing, the 90% the other day, and I had come back from a meeting and somebody had challenged me like that somebody had to own 90% of an opportunity zone fund. And I said, no, that doesn't make sense to me. And you had said, no, the rule is that 90% of the assets that are in an opportunity zone fund must actually be in an opportunity zone. So that's where I thought you were going.
Well, what I worry about too with that scenario is when you jointly own a property, let's say you have that doubling requirement and your co-owner is, I don't have enough funds, I don't really want to do it. They have no incentive to comply with all these opportunity zone rules that you have to comply with, or you start getting fined.
Right.
So that's why I would not recommend doing that. It just makes me nervous.
Oh, look at this.
Oh, yay.
We've got some
name suggestions.
Yeah, this is great. So we got name suggestions for our running team.
I see a lot of tequila in there.
I do, which is, I don't know what that says about us, but like, so name suggestions so far for our team that's going to be running the Kauai Half Marathon on Labor Day weekend is, okay, the first one's Team Tequila Trotters, Trowbridge Team Tequila again. Wow.
You guys heard I don't drink, right? This isn't fun.
Yeah, and actually another person on the team. Okay, Team Tennessee Whiskey, Team Tequila Trotters again. Oh wait, I'm just reading the name. Like, okay, Uplift, Syndication Fleet Feet. I kind of like that one.
Fun.
Crowdfund Flash.
I like that.
All right, so listen, there's some good ones in there. There's some really insulting ones in there. Like, I don't know what this says about us.
Okay, we won't close name suggestions yet. If you have more ideas.
Well, we're not the end all be all either.
No,
we gotta take it back to the team. And if you want to join our team, I really want to encourage you to come to Hawaii, run with us, train with us. We're all training together as a firm. It's been so much fun. Lauren and I've gone out running. Clement gets up at 4:45 in the morning and runs. Yeah. Lauren, Nancee and I talk about running.
We do a lot of time. I've been running.
Yeah. But if you want to email more suggestions, please do email them to our marketing lady, Lauren, Lauren at crowdfundinglawyers.net. That's Lauren, Lauren at crowdfundinglawyers.net. and we will pick the best name, and whoever wins will be the recipient of Sport Legs by Menon.
By crowdfunding.
By Crowdfunding Lawyers. Well, no, there's a patent on these. I can't.
Oh, yeah.
Sports Specific Zinc.
Yeah, we don't want to do any
Stagecoach
IP
Road, Boulder County, Colorado. So made in the USA, folks.
Thanks, everyone.
All right. Thank you, everyone. Have a great rest of your weekend. We'll talk to you soon.